Today we're looking at families with young children and why they should look at a variable rate mortgage rather than a 5-year fixed. So why a variable instead of a 5-year fix? This may seem counterintuitive. I mean, the general rule of thumb for most people is if they think interest rates are going to go up, you should pick a 5-year fix because then you know what your rate and your payment will be for the next 5 years. But we found 5 reasons not to choose a 5-year fixed, especially for families with young children. So reason number 1 why a young family should choose a variable over a fixed is because the variables generally have a significantly lower interest rate than what the fixed rates are. So at the time of filming this video, you can get a variable rate for 1.2% lower than you can get a fixed rate. Now that means that you're going to have a 1.2% window for interest rates to go up before you're worse off. That's a big window. And in that period of time that it takes, if interest rates do actually go up, to increase that 1.2%, you have a significant opportunity to save a lot of money. Reason number 2 to take a variable rate is because of that lower rate and the opportunity it provides to make a big dent in your mortgage early on. Let's say you had 2 options. One was to take a variable rate at 2.2% or a fixed rate at 3.4%. Well, if you take the variable rate at 2.2%, you can actually set your payments to the same as they would have been if you took that 3.4% rate. Everything, because the payment's bigger when you do that, all the money that is over and above the payment that you were supposed to pay at 2.2% goes to principal, which reduces your mortgage amortization by quite a bit. So to sum that up, you make a bigger payment equivalent to the 5-year fixed rate payment that you would have had to make, and because you're making a bigger payment than you have to, you shorten the amortization on your mortgage. So reason number 3 to take a variable over a fixed rate is because if you do believe that interest rates are going to go up, and they do actually end up going up, having a variable rate allows you to feel the increases to your payments over time, versus if you had a 5-year fixed mortgage, which in a global sense, when you look at terminology that's used in other countries, is really just a 5-year adjustable mortgage because the rate adjusts every 5 years. Well, at the end of 5 years, if rates did go up, you're going to feel an adjustment in your payment. And you're going to feel what we call payment shock, which is your payment going up all at once overnight. Now, variable rate, you feel it gradually over time if interest rates do go up and you pay the lower interest rate. But if you have that 5-year fixed and interest rates do go up, you will potentially have a massive lifestyle change overnight because of that increase to payments that you'll feel upon renewal. Reason number 4 we recommend variable rates over fixed is because central banks have a tendency to overshoot. So very rarely do interest rates increase in a linear fashion. So in other words, they don't typically go straight up and only up over time. Central banks have a tendency to overshoot, and what ends up happening is they'll increase interest rates, the economy will slow down a little bit too much, and then they have to lower them again. So just as much as there's a chance that interest rates will go up over time, there's also a chance that interest rates will go up and then come back down. So you may not actually see them go up as much as you think that they will go up. The last time interest rates were as low as they are now, it took from basically 1950 till the early 1980s for them to go up from 4% to 10%. That's because of that overshooting and the banks having to increase rates and then decrease them and go up and down over time until they actually got up. And reason number 5 that we recommend that new families look at variable rates is because there's actually a really good chance that a growing family will be a moving family. So one of the things we see frequently in our business is families that have a child and then have a second child a couple of years later and then realize their house is too small. If you have a variable rate rather than a fixed rate mortgage, you'll probably have a significantly lower payout penalty, which when you do decide to move will give you all kinds of additional options when it comes to selecting your next mortgage. Because with a variable rate, you'll have a 3-month interest penalty, which means a fairly low penalty. And because you have that low penalty, you'll be able to make the choice to pay it out rather than being forced to port your mortgage. And then once you've paid the mortgage out, you'll be able to look at all kinds of different options. We see clients on a regular basis that save tens of thousands of dollars just because they had the ability to choose a different mortgage than the one they had chosen in the first place. At the time you get your mortgage, you may select a lender. It may have the best rates going at the time you get your mortgage, but 3 or 4 years down the road, there might be other lenders that have other rate specials, and having the ability to look at your options and choose could save you a significant amount of money and also allow you to qualify to purchase a bigger house. So those are 5 reasons we think that a new family should consider a variable rate mortgage. I know they seem counterintuitive, but 3 to 5 years down the road, you may be thankful that you chose that variable rate over a fixed. Hey, if you've got questions, feel free to contact us. You can reach us at our website, mortgage360.ca, anytime, 24 hours a day. Send us a message, give us a call. We're happy to help you.